Dennis Wright. Ooh, we're recording. Got it. Mr. Dennis Wright, UMB Bank President. Dennis, it's
Yeah,
all you, brother.
thank you. Okay, good evening. My name is Dennis Wright, and I'm privileged to lead the Dallas market for UMB Bank. We have a strong team of middle market bankers with expertise in a variety of areas, including private equity-backed transactions, subscription line lending, as well as a deep knowledge and history banking and advising other privately and publicly held companies and their management teams. I'm going to serve as the moderator this evening. We'll be discussing various aspects and items to consider when going public via a SPAC. We'll get a current state of the SPAC market update, and we'll discuss several other legal, tax, and accounting considerations pertaining to SPACs. If you have questions that you want for me to ask to our presenters tonight, please just send those directly to me in the chat, and I'll try to get those as we have opportunity. But the first thing I'd like to do is introduce our panelists and have them take a couple of minutes to share a bit about themselves and their particular expertise on this topic. Today, we are privileged to have with us Alan Annex, shareholder at Greenberg Traurig, and Zishan Khan, partner, assurance services, and SPAC services leader at Weaver. So Alan, why don't you go first, and when you're done, throw it to Zishan. And then after that, we'll start into some of our questions.
Sure, very pleased to be participating on this panel and look forward to a great interactive discussion. I'm one of the co-chairs of Greenberg Traurig Global Corporate Practice, been a 33-year practicing mostly capital markets lawyer. First 30 years of that in New York, the last 21 of that at Greenberg Traurig. 3 years ago, I moved from the New York office to the Miami office of Greenberg, which was our original founding office. So based down there now. And it's been an exciting time. I've been involved in the SPAC space since the product was invented back in the mid-90s. I was one of the early architects of the product and have been involved in all the various iterations. They were kind of dormant for a while. They became popular in the mid-2000s when I launched Time was $100 million. It then was the largest SPAC ever done. They took public a company called GLG Partners, one of the big UK-based hedge funds. And that kind of put them back on the map for a while. Then 2008 financial crisis happens. They went out for a while of popularity, and now obviously they're very popular again today. So I look forward to a very interactive dialogue with the team, and I'm very involved in both the legal side of the SPAC, but I'm also very close with all the underwriters and investment bankers that do the SPAC and the de-SPAC. When we talk about SPACs later on, the IPO is the IPO of the SPAC, and the de-SPAC is the business combination that transforms the SPAC into the public operation. So let Zihan say hello, and then we'll get into the meets later on.
All right, great. Thanks, Alan. Zishan Khan, I'm an audit partner at Weaver, part of their public company practice group, and I've been involved in several going public transactions. I started my career at the Big Four at PwC, spent about 10, 12 years with PwC in different offices, started off in Houston, 5+ years in that office, went overseas with PwC as well. I was in their Dubai office for about 4 years. And then moved to the West Coast for a couple of years. I was in the San Francisco office, again with PwC. Been an audit background, I'm a CPA by profession. Got involved being in Houston, obviously, with the oil and gas industry, and then manufacturing, retail, and a little bit of technology as well, which I got to do work on the West Coast. And then after the West Coast, basically I moved to Oklahoma City to work on Chesapeake Energy, and that was kind of my main client here from the oil and gas background. And then I'm still based in Oklahoma City. I opened up the office for Weaver back in 2019 here. So it's been about 2 years, and we've seen a lot of. We'll talk about all the SPAC stuff in a minute, but seen a lot of growth in that area, and that's why I'm happy to be here. And hopefully we can get you all coached on some SPAC stuff, but I know there's people in the room who've done this many times as well. So it'll be interesting to hear some comments and questions. Dennis?
Okay, I think we were going to try to have our first polling question now, if we can.
You should go ahead and continue the
Okay.
presentation through the polling question. And you, as it gets answered, you'll see the results.
Okay, well, as we see those coming in, I'm going to start with Zishan. So very high level, can you just tell us what a SPAC is and then discuss the financial reporting requirements for a target going public via SPAC?
Yep, thanks, Dennis. So I think as we were talking in our breakout session, a SPAC is basically a blank check company or a shell company, as the SEC defines it now. It's really created for the purpose of doing an acquisition or acquiring an operating company. So the SPAC itself has no operations. And remember, our focus today is really more on the de-SPAC side, where it's the acquisition that the SPAC does of the target company. And we're not really talking about the IPO process of the SPAC itself. Now, remember, because the SPAC is a public company, whenever they go through an acquisition, they need to have a shareholder vote. So typically what they do is they have to submit a joint proxy / registration statement as part of this process. And that's where all the financial information comes in. So what I'll do is I'll kind of break it up into two pieces, and I think this will help the people who are with the portfolio company people in the room and from the PE side. So when you're submitting this registration statement, certain information about the target has to be included in that statement, right? And so the two pieces I want to talk about is one is let's talk about the historical financials and what needs to go in there. And then the second, we'll talk a little bit about the pro forma financials that have to go in there. So from a historical sense, you have to include generally 3 years of financials, balance sheet, primary financials, balance sheet, income statement, all your equity and cash flows and all of that. There are certain rules that allow you to reduce that to 2 years. Generally, SPACs get the exemption to be classified as an emerging growth company. So that usually helps. And then the target companies, if they're qualified as a smaller reporting company under the SEC rules, you're also able to get a 2-year kind of use 2 years of financials instead of 3, which is kind of a leeway that the SEC has given out there to reduce the burden on these private companies. So generally 2 to 3 years of financials, and then those will be your annual financials. And then you'll also have to present the latest interim financials into this registration statement. So remember that it's not as easy as, just those interim reports. The requirements now, so that's what will go in there. The second thing is, if you are as a private company or as a portfolio company, if you are getting audited financials today, you're probably getting audits under AICPA or under a GAS standard. But to be able to submit your financial information into this registration statement, you will have to go through a PCAOB audit, which is the rules that are used on public company audits. So this is an important point to note. A lot of times when companies think about these going public transactions, you really have to think about the lead time. There's a lot of this, you'll have to go through re-audits. If you're getting audited today, that's great. You'll still have to go through re-audits under PCAOB standards. So that'll be for your annual. And then, for those interim financials that I talked about, you'll also need to get them reviewed by the auditor. So again, they're not going to be just internal financial that you can run from your ERP. Someone has, your external auditor has to lay eyes on it and get you through the review part. So that's I think one bar that we should definitely think about. I think the second piece that's really important from a portfolio company perspective is a lot of private companies today may be utilizing some of these private company GAAP alternatives. And which is very common, and the reason why it's created is to reduce the burden on private companies. So if you are electing today to utilize some of those private company elections, you will not be able to do that. So you will have to undo the effects of those private company elections, and you have to almost present your financials as a public company, right? Because that's what the SEC wants you to do, is unwind the effects of that and get that done. So that's another important item to think about, because it definitely takes a lot of time to get through changing your previous accounting into, kind of undoing the effect of that. With that comes another piece, which is the adoption of new accounting standards. That's another important piece. So if most of you have been in the industry a while, if you remember a couple of years ago, we had our ASC 606, the new revenue recognition standard had come out, and it was a huge project to get through it and get it implemented. If you're a private company and you used, well, I guess that's an old example, but I'm talking about current new accounting standards that are coming now, you have to adopt them using public company dates. The SEC wants to really see that you're capable of operating and running as a public company before you, as part of this registration statement. So that's another item. If we were deferring the adoption of a standard to a later date using the private company dates, you will not be, you will most likely not be able to do that anymore, and it's be prudent for you to do that now as part of the registration statement process. Then the other thing private companies are not used to, I think, is MD&A, right? So MD&A is management discussion analysis. That's another pain point usually, because the accounting group or the financial reporting group has not really dealt with that, and they haven't gone through that process. And in their private company financials, that's not required, so they don't do it. But when you submit your financials into this registration statement, again, you will have to have an MD&A for all the periods that are being presented. And an MD&A generally is just the, it's a written format of kind of talking about how the business has been and what's changed over the periods that are being presented. And then I think the last one I would say is another important one is, a lot of private companies are either doing acquisitions or are looking at acquisitions. That's because there's a story to their growth, and that's probably what makes them attractive to the SPAC. So if you have done an acquisition and that's significant in your most current recent year, there may be a situation where you may have to present separate audited pre-acquisition financials for that business that you acquired. So that's another important item, because it takes time to get these things done and ready. So another thing to think about from a historic financial statement perspective. So the other thing we need to think about is the age of the financials. So this is another one, and I'm sure, Alan, you've seen this many times, is when you're filing the registration statement, the SEC rule is that your financial statements cannot be older than 134 days. That's the rule. So to give you an example, if you're filing, say, November 1st, your registration statement, you can include, if you're a calendar year company, you can include your latest interim financials could be June 30, which would be Q2. But if you file on November 15th, you will no longer be able to use Q2, because that will be considered stale in the SEC's eyes, and then you will have to now include Q3 financials into the registration statement. So sorry, Alan, were you wanting to say something?
Oh, I was going to comment in how much good collaboration there is between the accountants and the lawyers on all of these points. So those numbers stale and those dates are really important. The two things I wanted to chime in on what you said is there's some things positive, some negatives. The SEC does give de-SPAC companies the same 1 year for Sarbanes-Oxley compliance that they do give a brand new IPO candidate. And the SEC, the SPAC financials really disappear in this, because even though it's structured as an acquisition, most of the de-SPAC the shares mostly go to the owners of the operating business. So therefore, it gets, as Jihan, something called reverse acquisition accounting. So it's really as if the private business what goes public as opposed to the SPAC buying the private business.
Right. So the private business, becomes the successor auditor. The predecessor, which is the SPAC, basically disappears, and the target company's financials become the financials of the future combined company. No, that's a great point. Thanks for that, Alan. And then, so that was all more on the historical financials, just to kind of give you all an idea of all the things that are out there to think about. And then on the pro forma side, pro forma is probably a little bit, it's not easier, but it's pro forma financials have to be included in the registration statement. You have to include same kind of periods that you include for your historical financials. Luckily, on the pro forma side, you're able to condense it a little bit. There are some rules that allow you to condense lines, so you're able to have maybe a more discrete presentation. Also, corresponding periods are not required, which is great. So there's no prior year stuff on a pro forma. It's all current year, and then you show pro forma adjustments to basically reflect the transaction. So generally, you include all of that into your registration statement. You submit that to the SEC. SEC is going to take that, go through it. Usually, at least what I've seen in practice, and Alan, you may have a comment, maybe have a view on this, but at least 2 to 3 rounds of comments is probably general, and it's probably what I've seen. Once you get SEC's comments satisfactorily responded to, the SEC kind of gives you the green light, and then you switch gears and you basically go back to your shareholders and you get the shareholder vote. And once that is done, once that shareholder vote comes in as positive, this is the harder one, is you have 4 days to submit your Super 8K. The Super 8K, generally, most of the requirements are very similar to what we talked about in the registration statement. So really, you'll just be updating your numbers and your pro formas and all of that. But it's a very short window of time. So, a lot of the times, once you get the SEC green light, you kind of make sure that you align your vote timing in a way that you're able to prep all of that behind the scenes and then hit the button the day the approval comes in. So that's really, Dennis, overall requirements of financials, financial statement requirements, and just things that I think are important to think about from a private company perspective. Just the level of rigor, the hoops they have to jump through to get this ready and be part of that, transaction.
Okay. Let's flip it over to Alan now. So Alan, as you noted earlier, SPACs have become incredibly popular over the past couple of years. It's not the first time that's happened, but that always begs the question for me of why. So can you kind of shed some light on the benefits, but also some of the disadvantages potentially emerging with SPAC?
Sure, absolutely, happy to do it. So the biggest thing you need to look at in connection with the de-SPAC is comparing it to a traditional IPO, right? Because the SPAC is not an alternate to an M&A transaction, although in a de-SPAC, you can take some shareholder money off the table, maybe 25, 30%, which you wouldn't in a traditional IPO. But when you look at the company wants to do a traditional IPO, and there's a little misnomer, the SPAC transaction, people say the SPAC transaction is faster. Well, it's faster in terms of knowing whether you can go to market with your deal or not. It's not faster in terms of from day one to day closing. So if you wanted to do a traditional IPO, you would hire Zishan to come in and do your PCAOB audit. You'd hire Greenberg to be your lawyer. We would work together to get that SEC prospectus on file with the SEC. That would usually take us probably 60 to 90 days. We would then be on file with the SEC, wait 30 days for a comment letter, and respond to those comments, and then after that next round of comments, go out to market the deal. So only then would you find out where the market receptivity is for your deal and whether you can price it in the range that you are hoping to price it. That's where the exceptional, advantage of going public through a SPAC comes, because now I'm a private company. I want to see whether I can go public. I'm going to sign a letter of intent with a SPAC. We're going to go out to a handful of 20 investors wall cross them, allow them to have access to our information, talk to them about the pricing of our deal, potentially their participation in a pipe, which we'll talk about later in the program. But if I know all that works, I've now locked in the valuation at which I'm going to go public in the first 30, 45 days. And before I've spent, $3 million in fees to get on file with the SEC, I then have to get to the closing, but I'm going into the closing knowing I've signed my deal with the SPAC and I'm doing the deal forward at the valuation I'm hoping for. Now, what's the other big advantage? In a traditional IPO, you have liability under Section 5 and Section 11 for everything in the prospectus, and that's strict liability. So the reason that no one has projections or forward-looking information in a traditional IPO prospectus is they would have strict liability for those statements. In a de-SPAC, the proxy statement used in connection with the de-SPAC is under the SEC M&A rules, which are not really meant for blind pool companies. They're meant for a company doing an acquisition of a operating business. So they actually require you to give information to the public, the same level of information that the board of the SPAC board of the public company looked at in approving the M&A transaction. You're required to disclose all that. So that's how you get the projections in. And the investor presentation that was used in those testing the water meetings with the investors who were wall crossed, that needs to get published as part of the de-SPAC process. So that's how all that information gets into the public market. We'll talk later about some of the, that has some benefits, but it also has risk, because now you have a public company, you're going to start your life as a public company, and people are looking to those projections quarter by quarter or year by year for you to hit. And as we've seen, unfortunately, many companies, because the deal took longer or timing takes longer, they're not hitting their numbers, and then they get a dramatic, market hit on their stock price. But the potential, the big overall decision, someone who's exploring a SPAC is looking at it as an alternative to a traditional IPO. Again, because we're not talking about the IPO of the SPAC, but every SPAC has embedded in it a 20% dilution, which is the promote that the sponsor of the SPAC holds for themselves in creating the SPAC. And that dilution is great. It's a way someone in a $200 million SPAC, for example, it's $50 million promote. But to overcome that, the SPAC is typically doing a deal with a business 4 to 5 times its size. So a $200 million SPAC is looking to take public a business with a post-deal market value of about $1 billion. So therefore, you could see 200 is the SPAC shareholders, maybe 100 might be the PIPE investors, 800 or 700 is going to the original owners, which is why they end up being the majority owners of the shares afterwards. Some where challenges now, again, all the things that Zishan said in his presentation, all of those things about the financials come up early, right? If in the first meeting on the SPAC, we find out that they have no, or they have audits by, Dewey, Cheatham, and Howe, on Market Street, not a big 6, big 7, big 8, or a firm that's PCOAB approved. So it's not only that the audit has to be PCOAB standards, has to be done by a PCOAB approved firm who's authorized to practice in front of the SEC. So that's usually a big, if they have private audits, they have to convert them, as Zishan said, into public audits and then audit them to PCOAB standards by a PCOAB approved firm. In the early days of the de-SPACing, the banks would still let you go out and do the PIPE even before the audits were done. In today's world, that's been taking longer. Therefore, the market has reacted that the people sign the deal, and then when we work on a deal, we try to get into the SEC within 2 weeks or 3 weeks at most. But if the audits aren't done, as Zishan said earlier, you can't file with the SEC until those audits are done. If you're not, and so a lot of the banks today, they won't even let you go out and sign the deal until the audits are done. I try to push and say, look, as long as we know they can be done and we have a real time frame, we try to get it done. But that's a lot of the tension that people deal with in that de-SPAC process. So, there's about 400 SPACs out there now looking for deals. So it's important, if you are a target, you want to pick a SPAC that adds value, right? That's a management team that can help explain your business. And certainly if it's a management team that can help the business, even better, right? So, if the management team knows the industry or can help explain the industry. So we're working on a deal now for Bob Diamond's SPAC. Bob is the former chair of Barclays. He's taking a cryptocurrency company called Circle public. And his credibility being from traditional Wall Street helps, soothe investors' understanding of new finance. So it was a win-win. Had they just gone to any SPAC, they wouldn't have had the benefit of the credibility of the SPAC sponsor, helping to tell the de-SPAC story. So that's, one of the main issues. So the biggest, again, that you get to talk about that valuation early. You get to do that up front. You then get to the closing later on.
Okay, so you talked about the de-SPAC and you talked about the PIPE. So talk about the interface between that and the kind of that second level of raising capital.
Sure. So that the PIPE's the most critical component of the de-SPAC process, and it's really designed to do three very important things. It's designed to show certitude of cash at closing, right? Let's go back to the main premise of the SPAC transaction. Is that under the original IPO, the shareholders have to be offered the opportunity to get their $10 back plus interest if they don't like the deal, or if the deal doesn't, or they just don't want the deal, or the deal doesn't trade well. The hope is that the deal will get announced, the stock will trade up over the redemption price. So all the money, all the shares will move into hands of people that want the company, and all the cash stays in the trust. But the PIPE, first most important thing done is, so I'm a target business. I don't want to sign a deal with a SPAC not knowing whether the end of the 120-day process, there'll be money in the trust. So the PIPE, most important thing the PIPE does is serve as certitude of capital for closing. Second most important thing the PIPE does is it provides more capital not subject to the dilution of the original SPAC. So a $200 million SPAC, if it does a $100 million PIPE, it's now bringing in potentially $300 million of fresh capital, but the dilution is only on the original two. So now the 20% dilution now drops to 14% because you're now dropping it by a third. So it's lowers the dilution. The third most important factor is it gives third-party validation of the valuation of the deal that the proposed de-SPAC is at. So you get high-quality PIPE investors like Fidelity, Putnam, Moore, PSAM, all of those big, long-only institutional accounts will look today at the PIPE in connection with the de-SPAC the same way they look at an anchor order in an IPO. So if they agree to buy stock at 10, that sends that market validation of the valuation, which again, when we look at current SPAC world, everything was rosy and great from about mid 2019 to about the April or May of 2021, when things came to a bit of a screeching halt relative to the PIPE market and the trading of the de-SPAC companies. But up to that time, everything was rosy. Every deal we would announce, the market would love it, stock would trade up, the deals would close, and all was happy. But I would never advise a client today to do a de-SPAC without a PIPE, because that's just going naked. You won't know whether you're going to get money at closing without that. So that's one of the most critical pieces.
I love this audience of really smart, accounting backed CFO people, because our question 2, would you invest in a SPAC? 66% said maybe. So we're gonna have more details. We're gonna convince this crew. All right, let's flip it back to Zeeshan. So from an accounting standpoint, financial reporting standpoint, what are some of the challenges that you see in your experience with people that are, that are using this method to raise capital and to make acquisitions?
Yeah, so I think the biggest challenge, I think, is the one I talked about it earlier. I think is just underestimating the PCAOB audit part of it, which I think Alan touched upon as well. If you've gone through normal audits, that's good, but getting through a PCAOB audit through a PCAOB registered firm, is a different ballgame, right? So I think that's definitely one huge thing. The other thing that's happening as we speak, and Ellen talked about this too. I mean, there's 400 SPACs out there, right? And if you just look at the quick stats on the last 2 years, right? 2019, there was like 25 SPACs. You come to 2020 and there's like 200 something, right? It's 220 or something. And then you come to Q1 of 21, and that's almost 300, so it beats all of 2020, right? So all of 2020, you had 220. Just put this in perception for a minute, right? 220 in all of 2020, and then 300 just in Q1. So that is a huge jump, right? A huge, I guess, interest or whatever you want to call it for some of the.
And you had some sponsors doing multiple SPACs. So you had
Exactly.
some sponsors doing 2, 3, and 4 at the same time.
At the same time, yeah.
We're calling them twins and triplets.
Yeah. So, that I think naturally what that's done is when I look at it from, and this is, my opinion, from an SEC perspective, I think, there's so much volume that's come through, right, in 2020 and just in 2021. Obviously this is an area of focus for them, right, and it's become definitely more higher. In March this year, SEC came out with this celebrity endorsement, kind of news, and I don't know if you saw that, but basically what they were saying, there's a lot of SPACs that are coming up, especially in the West Coast, right, from Hollywood, where there's Hollywood money that is being invested into the sponsor group, right? And the SEC's kind of alarm bell, or whatever you want to call it, was, hey, just make sure you look at the product. It was a discussion, or it was directed towards investors to say, make sure you look at the product that's underlying the investment, and not just the fact that, I love Shaquille O'Neal and I'm going to invest in the SPAC that, he's a sponsor in. So, that was another kind of just, making sure that investors are looking at this stuff and not just a herd mentality where, you're following kind of the crowd. And then in April, just a month after when the infamous warrant accounting issue popped up, right? And, that has just completely changed the dynamics. I think that was a huge item that came up. So the warrant issue, just a quick high level, basically after the SEC's review of several filers, as you all know, because there was a huge backlog, obviously they were probably going through. And, one of the accounting items they brought up was the fact that these warrants that are issued as part of the SPAC, which converted to common stock upon the de-SPAC, were accounted for as equity, primarily in the financials. And I think their conclusion was that they're not. They should be more accounted for as a liability, because there's some unknown factors here, and how all that plays. And so that really changed the dynamic and the kind of the, I would say there's been so much frenzy on that topic. And I think, I don't know, Alan, if you know the exact numbers, but I know there's 500 plus.
Yeah, so it came up in the context, it never came up in the IPO context initially. It came up in the context of the first K or Q the de-SPAC company was filing, when the big four generally, or big six, accounting firm were now the auditors saying, hey, we have these warrants. And they looked at the warrants fresh, not the way the 3 or 4 firms that did most of the SPAC accounting looked at it for years, and the SEC had looked at it for years. So when the issue started brewing, we knew it was brewing because we'd get a call, and one of the big accounting firms would say, hey, can you give us a legal interpretation on these sections of the warrant? Would they ever have to be cash settled? And we would say, oh no, the way that provision works, it's just there for belt and suspenders, but it's never intended to be cash settled. And that would satisfy them. They'd put a memo in their file and they would stick with equity accounting. Then a certain one of the accounting firms, whose name I won't mention, on the phone, on the video, basically said, we disagree, no lawyers, you're wrong. We're going to ask the Office of Chief Accountant. Well, you never ask the SEC a question you don't know how they're going to answer. So of course, they asked the Office of Chief Accountant. The Office of Chief Accountant says, oh no, this should be liability accounting.
That's how it all went down, huh?
That's how it all went down. And then that held up. So immediate, imagine this, so this was right at the time of the peak of everything. So you had just had
April, yeah.
300 new SPACs that had to file their 10Qs. You had about 30 or 40 closings where the now de-SPAC company has to file its first 10Q.
Mm-hmm.
And you have all the existing SPACs that still hadn't found deals who had to do their Ks and Qs. So it was, and everyone had to then do evaluation of the warrants under liability treatment, which is a fictitious liability, right? So you're booking a liability for something that you will never, ever have to pay. No one in the market cared about it. It had no economic consequence. And in fact, Zishan, I guess, under IFRS, all warrants are reported this way. So in Europe, people have been dealing with this issue forever. So it was crazy. We did everything we could. We a bunch of the lawyers tried to reach and get to CorpFin and the SEC, and they basically wouldn't even talk to us. It was crazy.
Yeah, and funny enough, it's still not a rule, right? It just came out as an order, or I guess an enforcement.
An advisory. It came out as an advisory.
Right, and it just threw the market in a frenzy, and maybe that's part of the reason for the slowdown. I don't know, but I think that definitely the SPACs were just completely focused on just getting their financial. And you can imagine, this is happening in April, right? So most of them have just issued their 10Ks, and they're like, okay, your 10K is wrong, and then they're getting ready to kind of do their Q1 reviews, right? So it was just a big thing. I think the SEC sent delisting notices to like hundreds of companies during that April through June time. But it seems like a lot of them have caught up. But I guess what I'm trying to say, I think the SEC, this is an area of focus for the SEC. I think the SEC wants to improve transparency, obviously, for their investors, and they're trying. They want to make sure that it's a conservative presentation, most likely. When kind of looking at the comment on leases, right? I think if you think about it, 2 years back when leasing came out, these were items that were never recorded on the balance sheet, right? Leases were just disclosed, and one of the the 842 guidance that came out was to make sure that the accounting now starts booking these items on their liabilities and making sure that the investors are seeing that these liabilities exist. So I think this is probably going similar direction. I think the other piece that's going to happen is that the next area of focus, I believe, is going to be on the forecasts. That's going to be an area that, we've had too many situations, and I know, Alan, you'll touch upon some of the current environment on the legal side there, but there's been situations where you have you've gone through a SPAC, you've done X projections, and you think that the target company is going to grow in a certain EBITDA X percent, and after the transaction closes, companies have come back and revised downwards, and I think that's obviously caused a huge hit in their stock price, let alone consumer confidence and all of that. So I think that's an area that I believe will be another area of focus from the SEC side, and I think it slowed down. So when you look at we're talking about numbers, Q2 ended up with only 50 SPACs, which so you went from 200 or 300, and now it's kind of 50. I don't know what the Q3 numbers look like yet, but it sounds like it's probably going to stabilize a little bit here, and hopefully some of these accounting issues are now behind. People are caught up, but there's going to be an evolution. I think there's just too many SPACs out there looking at this point, and maybe it's going to be international markets. Maybe it's because it's not all domestic game anymore, right? Even the SPAC sponsors a lot of them are international too. So that's my 2 cents, Dennis.
Yeah, Hey, did you see the question? I think it's to everyone down there, but did you see the question from Mark Brown? Is that something, Zishan? that you
Yes.
can
Yes,
speak
I can. So on the auditor independence, so I think, I don't know which direction you're trying to go, Mark, but just generally, you know, the PCOB standards, the independence rules are much tighter. So if as a public auditor of a public company or a company that you're performing an audit under PCOB standards, you have to go through kind of pre-clearance on any other non-attest or any other services that you're performing for that company through the audit committee, and you have to make sure that there are just checks and balances in place, that there's no scope creep risk there, and that you're not basically doing things that you're not allowed to do, and then in turn coming back and auditing your own work. And so that's, I think, definitely a thing. Usually, on the private side, you can also assist with tax prep and also be the auditor at the same time. But on the public side, that's that doesn't work, so you can't do that. Private standards, auditing and providing tax prep. Exactly. Yep. So that's kind of where I was going. So you cannot provide tax prep, so you have to have a separate firm to do that. The separate firm can come and help you prepare your provision. And then the audit firm will review the provision and kind of sign off on it, but they're not going to be the preparers for it. So that's definitely one.
I just one where the firm got tainted because it had done the tax returns for the principal shareholder of the company. And we wrote for a ruling saying it was okay because we thought that work should have been excluded, and SEC wouldn't give us the waiver.
Yeah.
So we bring in another firm and reload the books.
Yeah. And then I think on the prep side, there are some kind of SOPs out there that help kind of get you there. But as long as if it's just a matter of taking data and kind of doing it, I'd rather stay away from it, just because it's such a risky thing to do. But if absolutely needed, I think the prep side is probably, but again, you still have to disclose it to the committee and get the audit committee approval and document all of that. And
it's already too late to not do it. If you're looking at something that already happened and determining whether they're independent to do the work, the bad work already happened. It's not like anyone says, oh, should I do this now, or will I be tainted next year? Because most of these companies haven't thought about going public through a SPAC yet. So the questions don't come up until it's already too late.
Yeah, exactly. Because you're doing it this whole time, and then the company decides they want to do public, and then when you start looking at the history, you're like, well, sorry, we're we're out of luck, and gonna switch things around and make some changes to make sure we're clear. And that's when a lot of times, their change of auditor is pretty common in the SPAC, de-SPAC transactions. Usually the de-SPAC auditors, generally, I've seen them stay on, continue, because they're more of the operating company auditors.
Okay.
Hope that helps.
Alan, yeah, no, I think Zishan, you kind of referred to this, but Alan, since he kind of teed you up, what are you seeing in terms of kind of the current legal and regulatory challenges out there?
Sure, a lot of the same things that Zishan just mentioned. So the SEC certainly has put out some guidance. They're asking for enhanced disclosure about the conflict of interest of the SPAC sponsors at the de-SPAC, i.e. that their stock would be worthless on a deal, and even if the stock trades down from the $10 that the shareholders are offered back. And in terms of the projections, we're seeing a lot of more questions in the comment letters from the SEC about the diligence that the SPAC did on the projections, what diligence the SPAC did. And they're asking for comments to be put in that basically say that this could be deemed a less tough, scrutinized way to go public, i.e. you don't have an underwriter who has underwriter liability for their work and role in the process. So that's what's coming from the SEC. Nothing that's saying you can't do SPACs, just saying the SEC is not a no-yes organization. It's a disclosure organization, so they can enhance and assist in the disclosure. Well, we're seeing a couple of trends in the plaintiff's bar. Early on, we would get an occasional letter from the plaintiff strike suit. That's becoming more common now. It seems silly to us because people are offered their money back if they don't like the deal, but the plaintiff's bar exists in our country to generate fees. So we're seeing letters come in, demand letters, requesting enhanced disclosure so that they could then petition the court and say they played a role in getting better disclosures, therefore they should get a fee for helping the public shareholders. That's been happening. The most recent trend, a plaintiff, the Bill Ackman did a very highly publicized SPAC where he tried to do a transaction that was actually not a traditional business combination. And that called attention to people about the whole, what's called the Investment Company Act issue, the 40 Act. So then two plaintiffs, a plaintiff's lawyer sued Ackman, even though he had already agreed to give all his money back to his shareholders. So I'm not sure what they thought they were going to accomplish. But they also sued two other SPACs that were both New York-based SPACs, past the 1 year, but not into their second year, claiming that they're illegal investment companies. Again, this is something that if you've ever tried to get 56 lawyers to agree on something from 56 different law firms, you would say that would be impossible. I work with a group of 4 of the leading SPAC lawyers in the country. We put out a statement saying, this is completely wrong. This is not what the 40 Act says. And within 48 hours, we had 52 additional firms agree to sign on that letter. And we published that letter. And I was interviewed over it because not for what it said, but for the fact that every law firm was able to agree on that one thing. But, you know, it's an issue. Again, if the SEC wanted to write, you know, my comment to the press was the SEC can change the rules. If they want to change the rules, there's a rulemaking process for them to do that with a notice and a comment period. You can't change the rules by plaintiff's litigation. So I suspect all of this noise will, you know, continue in the SPAC space. I think that, you know, you're seeing better and better quality companies go public this way. That's going to only help the product, you know, long term. But you know, we never said that you didn't have liability for the projections. You don't have strict liability, as I mentioned earlier, that you do if it was an IPO, but you certainly have 10b-5 and other liability for misstatements. So people have to really, you know, do their homework on those projections and make sure they're right as you lead into the de-SPAC process. And I think you're going to see more and better disclosure, which is only good for everybody involved.
So if 50 plus lawyers all agreed, it's clear that they were all, they weren't getting paid by opposite sides of the transaction, because I've never seen that happen, even with 2 lawyers. But anyway, impressive. I should have interviewed you before. Hey, did you see the question from Robert Ruff? Will Lordstown and others possibly lead to SPAC sponsors having a sort of underwriter's liability?
You know, I don't think so. So the underwriter's liability is a very strict concept under the SEC rule, and the SPAC sponsor is not and won't be deemed an underwriter. That doesn't mean that the SPAC sponsor won't be, you know, if they have a duty, and we take that duty seriously when we're on the SPAC side, to do their diligence, you know. And it's funny, I would always say, oh, you do the same level of diligence an underwriter would do in an IPO. Well, I actually say it's higher now. We're doing the same level of diligence an M&A buyer would do in an M&A transaction, which is a higher level of diligence. So I would argue that, you know, the SPAC sponsor is going to be, you know, held to that high level. Now, from a legal standpoint, the sponsor really has no legal role in the SPAC. The sponsor's role in the SPAC is just to hold shares. The SPAC has 5 directors, 2 are representatives of the sponsor, and 3 are the independent directors. When the business combination closes, those legal entities merge. So if there's any liability for something the SPAC did pre-deal, it really is on the operating business going forward, not the old SPAC, unless someone's going to claim it was activities of the director itself. So I don't think the sponsor is going to have underwriter type liability. I think the directors have liability as directors, and I think the entity has liability. And the SPAC would disappear and have no assets anyway. So frankly, if you want the deep pocket after a successful de-SPAC is the operating business, which has A, the operating business, and B, the cash it just got from the de-SPAC transaction.
Okay. I don't see any other questions right at this moment. Zishan, do you have any other kind of parting thoughts or comments? I would say the same to you, Alan.
Yeah, I would say, the focus should be on the management team of the target. If you are going to be at the target, okay, if you find yourself in a situation where you are approached by a SPAC and you're interested and you're going through it, I think the biggest piece of advice would be just make sure, that it's the valuations or the projections, they're all realistic. Be able to stand behind them, whether scrutinized or, if you're able to kind of pull this and kind of break it apart, your projections should be accurate. And, everyone, obviously there is a little bit of a risk that, that they're escalated or, the volume is maybe too much there, but I think that's the piece that the management teams really need to hone in on and make sure that, yes, they're going to see these big dollar signs and all of that, but making sure that they can stand behind, and especially, in the tech and these kind of industries where there's so much unknown, I think that gets even harder, right? And if you have a very stable old business that you've been doing for many, many years, it's still easier to have some kind of projections, but being into, these startup pre-revenue companies having X, growth targets, just make sure it's reasonable and that there's no backtracking there.
And I would say, I know there's a lot of people in the audience in the energy world, at least felt that from the breakout group I protected in. You generally, that's a tough space for the SPAC world, right? Because you really, when you go back to the analysis of the size of the SPAC to the size of the company and the private value, the public value, things that trade based on yield, very hard to overcome the dilution of the SPAC. So you're typically looking at operating businesses. When I looked at my 2020 deals that closed, there were two electric vehicle deals, 2 LiDAR deals, 2 battery deals, 2 mortgage deals, and then 2 boring businesses. So you're seeing a lot of growth, unicorn type businesses going public, not a bread and butter yield play. A lot of clients will call me and say, hey, I've got can I turn a SPAC into a REIT? And they think, well, aren't the SPAC investors looking at yield? And well, yes, they are, but they're just temporary buyers for that yield. They're looking for a growth company to come into the SPAC. So it's hard to do something with yield, just if that comes up.
Well, I'm not seeing any more polling questions. If there's anybody that has anything that they want to ask, we can hang on for another second. And I think the question that's in there now is more maybe one for Eric in terms of getting the CPE. But I just want to thank our speakers today. I want to thank their firms. Thank you, Alan. Thank you, Zishan, and thank you, Greenberg and Weaver, for taking the time to share with us. And we really appreciate it. I hope it was helpful for everybody. Eric, do you have anything that you need in terms of closing us out or any other additional information?
Mute.
You're on mute. There you go.
There you go. Okay, thanks for everyone for participating. Our next event's going to be February 1st. We're still working on what that content will be, but there'll be other SIG meetings between now and then. So that's all we've got. Thank you to Dennis and the sponsors and the speakers for everything you guys have done today. Thought it was great and we really appreciate it.
Absolutely. It was
Thank
great.
you. That was
Thank
great.
you. Thanks for having us.
Appreciate it.
Bye.
Yep, thanks.
Great. Thank
Thank
you.
you guys.